Hi, everyone. I'm so excited to be here today discussing something which is not just the future of risk management, but is happening right now. And that's how AI is transforming the way we manage risk. So we know the risk management is a vital part of any trading journey, and we know many traders struggle with managing the risk properly. But I'm not going through the basic stuff. I'm gonna mostly focus on the role of AI. I know you have heard about the position sizing or stop losses a lot. However, let me start by pointing out something that we have all in common as retail traders, and that's becoming more profitable trader. We are all here to succeed markets, yes? However, we see, however, we see the data tells us a different story. Based on the FCA, the Financial Conduct Authority recent study, 76% of all Forex traders lose money. And it might be surprising, but the crazy part is that they don't lose money because of a lack of skills or knowledge. They lose money because of poor risk management. So you see, the risk management is something that is killing all traders. On the flip side, another study from CFA Institute shows that 80% of long-term successful traders attributed their success, you guessed it, to effectively managing the risk, to sustain profits long-term. So you see, the risk management is very vital part, again, and these studies show us that many traders are struggling with that. But we see some pro traders, you might know, who they don't put more than 1 to 2% of their account at risk on any single trade. Even when they lose more trades than they win, they usually come out on top. So how is possible? The secret is the term of expectancy. So I'm not sure if you have heard about that, because this is one of the most overlooked aspects of trading. Many people are getting crazy with finding the holy grail, the strategy that can, with a high win rates. But I'm sorry to, I really don't want to disappoint you, but we are going through to prove all of this stuff not going to work if you don't take care of your expectancy. And expectancy is a very simple formula, as you see here on my screen. And the goal of a professional trader is to maintain positive expectancy. You can consider expectancy, let's say, as a conclusion of all efforts you put in your trading journey. It means your strategy, your reward to risk ratio, and also, let's say, your win rates, your losses, how you manage your emotions during the process, the decision-making process. And the only thing we need to focus on is to maintain the positive expectancy. And here is another interesting data that the same CFA Institute study shows. Traders who focus on their expectancy are 40% more likely to sustain profits long term. And this is actually where we are going to focus through some real world examples. Here I have some, let's say, trading statements. Meet trader A. They started with a $1,000 deposit and made 34 trades, netting a profit of almost, let's say, $1,500. But you see, it's not nothing here is let's say, skeptical. But what here is making a difference is that the largest drawdown was only 5.75%, and they ended up with the expected payoff of $40 only. And what's telling us? It tells us with a positive expectancy, you really don't need a high, let's say, reward to risk ratio to become a profitable long term, because they ended up with a profit factor of 15. Sorry, it just dropped to the other. Yeah, 15.67. So the case here is controlling the drawdowns. And if you are not still convinced with that, let's look at the second statement. Here is a trader B. They started with a much larger amount of $1.4 million, and they made an impressive profit of, let's say, of about the $84,000, which is incredible. But what's the catch? They had a large drawdown of $422,000, which means with a few more losing trades, they could have wiped out a large portion of their profit. And you see how the graph is showing us that they even lost almost everything once, but they injected more money in their trade, so they could actually stay in the market. What's the big lesson here? Big wins can be tempting, but if you are not losing, if you are not managing your risk, it's like playing with fire. And if we go further, finally we have trader C, and they started with, let's say, deposit of almost $782,000, but ended up losing nearly all of it, the losses. So they're out of the market. And I know all of us have the similar, maybe, experience in the different levels, yeah? So it shows that they made the expected payoff, or the expectancy, of minus 798 roughly dollars per trade, and even those high win rates, with a win rate of 71%. This is against all the thoughts we have about the trading strategy. A trading strategy with a 71% win rate can actually result in ending up with nothing if we don't manage our risk properly. So we see, even with that high win rate, they ended up with losing almost everything. And here is the lesson that we can learn from these examples, that risk management is the vital part of trading journey, and we have to take care of our expected payoff, as you see here, to become a maybe profitable trader in long term, because the success in financial markets is all about profitability in long term. In conclusion, you see here from these examples that, first, high win rates doesn't guarantee success. Even high amount of money doesn't guarantee success. And even the best strategy with, let's say, a high reward to risk ratio doesn't guarantee success. In fact, it's all about managing your risk properly. But $1 million question here is that why many traders struggle with managing the risk properly? What's the problem? It's not because they don't know it is important. We have all heard about that. Okay, risk management strategy are the two pillars of success in financial trading, but there is a one missing part, which is discipline. Many traders can't keep up with rapidly changes in the financial markets because they lose control over their emotions. They lose control over, let's say, the market fluctuations. And this is where many of them fail. But what's the solution to that? Answer that $1 million question. The answer lies in the work of AI, artificial intelligence, which is here to help us to manage our risk and make it easy for us. And how it works, let me first distinguish the traditional trading bots, if you're playing with them on, let's say, MetaTrader 4, MetaTrader 5, with the artificial intelligence. Okay, we know the trading bots are very good, yeah? Many of them, we know them as the expert advisors, but they follow just the rigid rules. They can't adapt with market condition. On the other hand, we have AI. Sorry, I lose control over that. Okay. We have AI with the capability to adjust our trading system with the real-time market condition. By going through, or let's say, taking care of three types of parameters. First, market sentiment. Second is market volatility, and then market conditions. So AI, first, can enhance our risk management by analyzing, let's say, the market sentiment through the social media, market report, and all the news feeds and the stuff that we can find everywhere these days. And also, it can help us to gauge the volatility of the market, to adjust our stop losses, and also our expectation about the win rate that we're going to take from the market through the, let's say, fluctuations during the market events. And also, it can recognize, it can make it easy, the pattern recognition, all of those technical indicators or technical shapes, or the things that usually is really hard for, especially not very experienced traders to spot on a real chart in a real market to make profit out of that. So this is the role of AI, but AI goes even further than that. It's not just the capability of that. AI can help us also to adjust our trading expectancy. And today, we know some tools, and we are going to introduce them to you also, that we see the result of, let's say, tracking the market sentiment, the volatility, and the market behavior is not just get aware about the market condition, but we can also have AI as our assistant to track our trading expectancy and let it adjust our, let's say, strategy in real time. And here is a very interesting data. Sorry, I need to take it back. Okay, some studies show that AI can reduce average portfolio volatility by up to 30%. And this is something really amazing. You remember what we saw in example 2, the high level of volatility during trading. Why? Because they just lost the control over their emotions because of the market condition. But here, we can use AI to reduce the average portfolio volatility by up to 30%. That this is the first step that we can take with AI. And then let's look at some numbers. Let me remind the source for you, because I think it would be very, very interesting. Yeah, it's here. Sure. Okay, AI doesn't just monitor your win and loss rates, yeah? It adjusts your strategy in real time, scanning, let's say, thousands of data points in seconds. And Deloitte finds that traders who use AI to track sentiments of the market reduce their drawdowns by 15 to 20%, which is another solution for traders. And also we see another study from the MIT, actually AI survey. They even found that traders using AI-enhanced risk management tools, that we're gonna get through them, improve their returns by almost 18% over 1 year study. And this is the thing, so we see the capability of AI to give us control over market volatility, to control our drawdowns, which you saw how we could almost double our account with only 1,000 over 34 trades. And also it gives us to increase our returns by sticking to our trading plan, which is the third missing part of any trading, let's say, plan. A strategy, a risk management, and discipline. This is what you need to become a profitable trader. But how we can use AI in practice? Here, I'm going to give you a straightforward blueprint. To boost your risk management using AI. How it comes? By focusing only on 4 parts in your trading. You see, out there you can find a lot of different, let's say, tools, a lot of different softwares, and everyone is claiming which is gonna be the best one for you. But if you want to act as a professional trader, I recommend you to take care only of 4 parts or 4 areas in your trading journey. First, AI-driven risk calculators. These tools can automatically adjust your position size. And at Errante, we offered let's say, platforms like TradingView and CTrader. They can integrate AI, and then you can use them to adjust your position size, especially during the high volatile market conditions. So this is the first thing. And also, let me introduce another, let's say, tools. That's a caveat. I'm not sure if you have heard about that. This is an Invest GPT. It specializes in, let's say, data analytics and artificial intelligence for trading and investing. So it can you can just easily search it and find it in the internet, and you can use it as your assistant to manage your position size by measuring the volatility of the market. And next is AI-based sentiment analysis. We know Forex trading is not just about, let's say, not about trading numbers. It has shaped based on the market psychology. All of us as traders in this market, our expectation, our fears, our greed are shaping the market. So, and now because we are living in an era of, let's say, social media, so we see everyone has the ability to make a community and post it and spread the fear, spread the greed, and spread everything. So we need to protect ourselves against all of these things, although it can be very useful. In that case, we can use some AI-based sentiment analysis tools, which are some tools like AlphaSense and PipFeed. They can scan all the real-time news feeds. They can scan all the, let's say, social media reports. They can give you the capability to instantly sort the news for your instruments you're trading, for the assets you're looking to gather some information about them, maybe and they can enhance your ability to first analyze the market to get the let's say to see the dark side of the data, maybe because if you remember the old days of analyzing and trading, many people were struggling with gathering data first, and they did need a lot of time to analyze that. And then in that case, we saw the opportunity just lost. But here, you can use these, let's say, tools to do some sentiment analysis in real time. And then adaptive risk exposure, there are also AI tools that you can integrate them on the MT5 EAs, like Quantify, which is a platform, another platform. However, you can also use it as the Pine script in TradingView, Errante's TradingView platform. And these are adaptive risk exposure AI tools that can adjust your leverage and a stop loss. At least, I know it depends on the capability of the broker you are working with, but at least you can get aware of, or you can get recommendation about your proper leverage and a stop loss level based on the market volatility and market sentiment, which is the measuring those, let's say, parameters of the market can be really tough for many traders. And then AI-driven expectancy tracking, which is the, let's say, which is the one that all of us are struggling with. And AI-driven expectancy tracking analyzes past performance and flags when expectancy turns negative. So in that case, you can stay on the top of your trading plan to see, oh my God, I did it wrong, I lost the track, now I'm in the negative expectancy. It means I need to review my trading plan again. Maybe it's because of my strategy, maybe it's because of my risk management, maybe I don't put a proper stop loss. In that case, who wants to know it as soon as possible? So we can, let's say, use AI for all of this, and please just remember that AI is not here to replace us. That's it, as a Forex trader, let's say. However, we can consider it as an assistant. We can consider it as a tool to enhance our capabilities, to analyze the real-time market, to manage our risk in a better way, to, let's say, just somehow exclude our emotions from our decision-making process during a time. Because become a successful trader in the market is not about a strategy, it's not about all of this stuff, it's just a matter of time, okay? Because at the end, you need to be a profitable trader over time. So it doesn't matter if you lose a couple of trades, but it matters to keep track all of these, let's say, factors involving in your trading strategy. And before I conclude, I would like to invite you all to come to our booth if you have any further questions. Errante 146 in Hall 2. Thank you so much for your time. Thanks a lot.